As an NRI, staying compliant with Indian tax laws while living abroad is an overwhelming task, like selling your property in India or understanding the TDS sections and transferring the same proceeds to abroad is a lot to keep a track on. But in this video, let me take a little bit stress away from you, like making you to understand what and all you need to know about a property sale in India. When an NRI sells a property in India, the respective tax implication depends upon how long you have owned it. For example, if you held the property for up to 2 years or lesser than 2 years, the gain from that respective sale of that respective property will be considered as short-term capital gain. And the tax on these short-term capital gain are under applicable income tax slab rates. If the property is held for more than 2 years, and it will be considered as long-term capital gain. The tax rates will be 20% with indexation benefit if the sale occurred before 23rd July 2024 and 12.5% without indexation benefit if the sale occurred on or after 23rd July 2024. This change in the indexation benefit directly affects NRIs and makes real estate taxation more expensive. Let us understand what is indexation benefit. Indexation benefit in the context of taxation allows you to adjust purchase price of the property for inflation while calculating capital gains. This will lead to reduction in the taxable portion of the capital gain as well as the tax liability of the capital gain. How this indexation works? For example, if you bought a property in 2001 for 50 lakhs and now you sell it for 1.5 crores in 2024, the actual capital gain on this transaction will be 1 crore rupees without considering the indexation. If you consider this indexation, the purchase price of the property will be adjusted to the inflation, considering the respective cost inflation index for the respective year of sale and the respective year of purchase. So, say it like it considered as the purchase price of around 1 crore, then the respective capital gain will be 50 lakhs. That is the half amount of the capital gain that we calculated earlier. NRIs have now lost this indexation benefit, meaning you need to pay tax on the entire capital gain without being adjusted for inflation. The next concern for an NRI in a transaction related to a property sale is tax deducted at source, popularly known as TDS. TDS is deducted on the whole sale value rather than on the capital gain. So the TDS rates will be for a long-term capital gain, it's 20% on the sale value if the sale occurred before 23rd July 2024 and 12.5% on the sale value if the sale occurred on or after 23rd July 2024. For short-term capital gain, TDS is deducted at the rate of 30%. So over and above these TDS rates, education cess and applicable surcharge will also be applicable. Remember, these TDS rates are applied on entire sale value. So the NRI ends up paying extra tax liability rather than the actual tax liability. If your actual tax liability is lower than the TDS that is to be deducted, and deducting the same affects your cash flow because the extra tax withheld will be refunded only after filing the return, you can apply for lower deduction certificate under section 197. As to ensure correct amount is deducted as TDS, we need to apply for LDC. The first step in applying LDC is to submit Form 13 in the Traces portal online. Next is to provide necessary clarifications and the necessary documents such as sale agreement, purchase deed and the applicable tax computations for the capital gain. Once approved, the lower TDS rate applies. So the buyer deducts the TDS at this rate and files Form 27Q. After these steps, the NRI seller receives a TDS certificate known as Form 16A, just confirming the deduction. So, applying LDC in advance helps the NRIs to avoid excessive tax withheld within the hands of the government. So, these are the steps for LDC. Now that we have covered the taxation portion, TDS and LDC application, the next important step is to transfer this sale proceed abroad. For an NRI to transfer a sale proceed abroad, there are certain steps and procedures by RBI. Once the sale proceed is received from your buyer to your NRO bank account, you need to obtain a CA certificate known as Form 15 CB, and you need to file another form known as Form 15 CA through your income tax portal. Along with these forms that you obtain from a chartered accountant and the Form 15 CA, certain documents need to be provided to your bank like sale deed and the tax paid certificate. Bank verifies these documents and process the repatriation, thus repatriating the sale proceeds abroad. So, but for certain properties like inherited properties from a resident and a property that you bought when you were a resident, there are certain other FEMA regulations that need to be covered. So, navigating Indian tax laws as an NRI doesn't need to be stressful. By staying informed and following the right process, you can ensure compliance. So, these are the necessary things and aspects you need to consider before selling a property in India as an NRI.